Good morning. As this year's chair of the New York Metropolitan Chapter of the Councils of Real Estate, it's my pleasure to welcome all of you to the July edition in our ongoing series of real estate webinars. As I've said before, counselors of real estate are known for innovation and creative problem solving, and we have a very big problem. The purpose of these webinars is to help us understand the size, shape, nature, and potential ramifications of this problem from as many vantage points as possible, and with frequent updates as new information becomes available, so that we can better assess the impact of the current crisis in order that we as counselors can become part of the solution as we advise our clients on their real estate interests. It's a lofty objective, to be sure, but with our deep base of expertise, experience, and ethics, our organization is uniquely capable of pursuing it meaningfully. And our speakers today are well positioned to help us do so. It's my pleasure to introduce today's speakers. Dr. Victor Calanog, CRE, is head of commercial real estate economics for Moody's Analytics Reis. Prior to the acquisition by Moody's Analytics in October 2018, he served as chief economist and senior vice president of Reis. Dr. Calanog is an expert on commercial real estate market and submarket forecasting, a leading property level analytics researcher, and prolific writer, speaker, and presenter on economic trends and emerging issues. Chris Henkel is a senior director in the Reis Commercial Real Estate Solutions Group at Moody's Analytics. Also based here in New York City, Chris is responsible for designing and overseeing the delivery of solutions that support customers' underwriting, research, risk management, and investing activities. Before joining Moody's Analytics in 2009, Chris worked in Dallas as a commercial banker for 12 years. He has since utilized his experience as a practitioner and a former Moody's customer to help hundreds of financial institutions improve how they measure and manage financial risk. As always, please feel free to send in questions. We'll be collecting them for the Q&A. Meanwhile, Victor and Chris, over to you. And Victor, you're on mute.
Thanks. Yep. Thanks so much, Neil. Took half a second or so to unmute myself, but thank you for the warm introduction, and thanks to you all, my fellow CREs, for your time today. We are in the third slide of our deck titled Agenda. For those of you who can't quite view the material, I understand our new normal these days. We'll make sure we walk you through the details if you're just, for example, dialing in by phone. I'll start. I've given a lot of webinars and hosted events for my fellow CREs before, and as Neil mentioned, I'm an economist, so you've been warned. The first part of the program will involve some economic theory and an update on the latest numbers, but don't fall asleep just yet. I know it's just 8:30 in the morning. We will not focus on dry academic things about which you can read a bunch of articles that you can find on the internet. We will focus on numbers that matter, that tell a story, or at least my read of the tea leaves. And more importantly than that, I'd like to help you think through the basis of many of these numbers, trends, forecasts, so that you can make up your own mind about what's likely to happen. So I think the focus of this discussion, therefore, is the practical application of data and analytics. We will cover the economy, multifamily, commercial real estate. We'll answer questions like, well, gosh, why aren't transactions occurring, and when will deal flow resume? And then I'll stop talking and let my colleague, Chris Henkel, guide you through what I think is the real meat of the discussion. When our clients, banks, LifeCo, CMBS issuers, servicers, opportunity funds, you name it, are thinking through, and how all of this might resonate with your situation. And with that, let's begin. Slide 4, cover page, titled COVID-19, Multifamily and Commercial Real Estate, Fear and Reality. Moving on to slide 5, where we present 3 economic scenarios which chart out our forecasts over the next year or so. I know things are rapidly changing, and they still are, but our forecasts have actually shifted fairly little over the last couple of months or so. We've built in expectations of how much the economy will contract in the second quarter, given economic shutdown policies. Answer: likely a record-breaking 30 to 32% annualized in the second quarter. That's about 3 times as bad as the prior record of 10% in the first quarter of 1958. And for those of you who can't view the slides, you would have seen 3 lines that dip almost in unison in the second quarter. That's your 30 to 40% decline in US GDP, and then an increase in a somewhat varying bumpy manner. The bumpiness reflects uncertainty of the recovery process. But wait, did I just say 30 to 40%? I thought you just heard me say 30 to 32%. The 40% figure is our worst case scenario, given that you want bounds around these forecasts if your job is to help quantify downside risk. The baseline is about 30 to 32%, that's what I said, but it could be as bad as 40%. And when will we know? The Bureau of Economic Analysis will release its advanced estimate of second quarter GDP on July 30. So in 8 days, we're waiting with bated breath to see what kind of bloodbath we are looking at. But wait, didn't we just add 5 million jobs last month in June? A total of about 7 million jobs in May and June. The recession is pretty much over, isn't it? I mean, that's what makes this quote unquote recession, which officially began last February, according to the record keepers, really difficult to interpret because it was brought about by a public health crisis and explicit policy choices to shelter in place. It wasn't an asset bubble bursting. It wasn't over-leveraged lenders dealing with chickens now coming home to roost. We shut the economy down more or less globally, starting at or around March, at least for many large economies. And then here in the US, we began reopening at or around May. So with an estimated 40% of the economy shut down, we lost that headline 20 to 21 million jobs in April and then started gaining it back in May. After all, if you're starting from a base of 0, even reopening a restaurant at 30% capacity means jobs gained. So in this slide, I show different categories of industries and where jobs began to be gained in May and where we continued to lose jobs. Leisure and hospitality, particularly food services and drinking places, were the biggest gainers at around 1.3 to 1.4 million jobs earlier, hence my earlier example. But you can see that we still lost jobs in several other categories like local government. The June 2020 numbers show a similar pattern, at least relative to June 2019. It's really interesting to see where jobs were gained, amusement, personal services, clothing, furniture. And on the bottom right, we see that unsurprisingly, nursing and residential care facilities lost a good number of jobs. So here we begin to dig into what makes up the headline number so you can make your own conclusions about whether we've begun climbing out of the hole, how much further we need to go, and whether or not we'll take a break soon and, I don't know, shut down again. Because here in slide 8, we see that the number of households participating in what becomes the basis for the national unemployment rate actually fell precipitously in May, from a trending average in the low to mid 80s over the last decade to around 67%. That's a 15 percentage point decline. Hey, even those guys gathering data on the labor market really got pinched by COVID-related policies. The BLS has a fantastic note in early June where they basically say, oh, the unemployment rate is 13.3%, but it could be 16.3%. So that's a big margin for error. We should take the general trend, in my view, as a positive, but scratch under the numbers when you think it through. Okay, enough about the economy. Let's talk markets. Let's talk commercial real estate. Let's talk business. So where are the opportunities? I mean, in early April, a Wall Street Journal article cited that there were close to 1,000 funds raising money to buy distressed real estate. Wow, they were targeting around $297 billion. That's a lot of dry powder. So where might the opportunities be? And let's take a look, therefore, where distress is manifesting. Here in slide 9, good luck getting a bank or a life insurance company to open their books for you and reveal which loans for which property types and in which geographic area are experiencing distress. So in lieu of superpowers like X-ray vision in that form, we rely on the CMBS market for the most transparent, most updated view of where distress appears to be showing up. No surprise when we collaborated with our client CW Capital to study what they were seeing in the front lines. They're a big player in the special servicing industry. About 84% of rent relief requests that they got were from hotel and retail properties. I was just on the phone with Dan Warsholak and Jim Shevlin yesterday, and we're actually going to update these findings. For relief requests, up to about 52% now are from hotel properties. Interestingly, as what we see here is that about 5% were from office properties. That's the pie chart on the left. With that said, CW also noted that they rejected about 30% of requests. This was always going to be a risk. We economists call it moral hazard. Hey, if your neighbor's asking for rent relief, why not you? We also monitor early warning signals in the CMBS world via things like servicer notes. So every time a servicer note is updated and mentions COVID-19, our team flags that loan. It might well be current right now, but we want to watch out for it and monitors its status. No surprise, as you could see on the pie chart in the bottom right, about 70% of all CMBS loans that mention COVID-19 in some form via servicer notes are once again in retail and hotel. Again, here in slide 10, just to emphasize what I said just now, I show that actually this data's current as of about a week ago. I show that for CMBS loans that do mention COVID-19, a lot of them are current, even for retail and hotel. But with that said, you could see about 25% of CMBS hotel loans that mention COVID-19 are already 60 to 89 days delinquent. And by some measures, hotel delinquency rates are up to its 2008-2009 peak. It got there in 3 months instead of about 2 years compared to the last downturn. So that's pretty nuts. So here's the puzzle. $300 billion of funds are waiting to deploy. Distressed assets appear to be emerging, right? So why is deal flow still more or less frozen? My colleague Chris Henkel will talk about this in detail, but I will hint at my theory as to why that is. The bid-ask spread is likely blown out. You likely have potential sellers holding out and not wanting to take reductions or steep discounts in asset values, especially if the asset is still generating some income. Hey, if I were a bank, I wouldn't want to mark an asset to what's projected to be a 20 to 30% value decline, right? I mean, where are the transactions and comps anyway? But if I was a buyer, I'd want a 40% haircut before I think this might be a good deal. And so the twain has yet to meet. And the story, I believe, will still unfold depending on how this so-called recovery plays out. So here's one potential comp. About a couple of days ago, the owner of the 73-floor U.S. Bank Tower in L.A. put it up for sale at $430 million. That's a 34% discount versus the last estimated value that the owner declared in its annual report just last year. But just to make sure that you remain confused, that number is still up from the $367.5 million that the owner paid for it 7 years ago in 2013. So I want to see how this will be presented. Will it be a 34% decline relative to pre-COVID levels, or will a creative analyst straight line that 2013 to 2020 growth rate and say that the comp should be a 2.3% CAGR over 7 years, and therefore we should grow other transactions by 2.3% relative to 2019? I think the jury's still out. We'll see, but I can't wait to hear analysts argue both sides. So in the previous two slides, we focused on the CMBS market, but that's less than 9% of the total multifamily and commercial real estate debt pie. If you zoom out and check in this slide the full $4.6 trillion or so of outstanding debt out there, you'll see that the same analysis needs to hold in the pie chart on the right. If we take a look at Lifecos, we see that they appear to have dodged the hospitality bullet because their existing portfolios only have about 3% in lodging. They're not out of the woods, though, because they have about 22% in retail. So you can bet we are having long discussions with Lifeco clients about various concerns. Because as you likely know from your household's behavioral changes over the last 4 months, while it floors me when I say that it's been that long, the proportion of retail that's done online really received a big kick in the pants thanks to COVID-19. We estimate that it's already at around 15.2% after peaking at over 16% or so a month ago. We have reopened, so a lot of us are itching to spend outdoors, but I don't think we are returning to the 11.4% level that we had at the end of 2019. The genie is out of the bottle, so to speak. That spells continuing distress for retail brick and mortar properties. Well, what about office? Are we going to work from home forever? Are you looking forward to 100% of your meetings conducted via Zoom? The reason we don't see comparatively large measures of distress in the office sector is because of the longer-term nature of leases for businesses that aren't retail storefronts and aren't facing immediate annihilation from online retailers. So on average, what I present here in slide 13 office leases run for around 9.1 years. It's a lease for space greater than 100,000 square feet. That average jumps to 12.2 years. So yeah, if businesses go belly up, leases get broken. But despite all the predictions you'll see in newspapers about the office sector taking a big hit from the work from home trend, I suspect it will happen more slowly. I probably will put it in some of those newspaper articles. But, June 24, our fellow CRE, Hugh Kelly, who's probably on the call right now, spoke to you guys about a similar event and emphasized that we need to be nuanced about how office will evolve. I'm sure he reminded you of how predictions were made back in 9/11 about how employers and households will leave downtown New York permanently, how it's going to be a huge exodus, and well, it didn't exactly happen that way. There are many reasons, however, why this COVID crisis is very different from even something as terrible as 9/11. So we need to be careful about extrapolations using the past, but still, the main principle is being thoughtful about what might happen next, considering the many moving parts. For example, it's easy to say, the use and consumption of office space will evolve more slowly. And because of long-term leases, it will take time for companies to reorient how they use their offices as well as their overall footprint. At this point, that's a platitude, right? So in this slide, I answer how much time exactly. We can also quantify that. So here in slide 14, we present the amount of leases that are turning over every quarter through 2025 for some of the largest markets. That is New York, San Francisco, Chicago, Boston, LA, and DC. On a quarterly basis, you can see that it's monotonically increasing. I do love that term. I take every chance to lob it during webinars. It's just a fancy schmancy term saying that it's constantly going up or down over the next 5 years. So unless there's an acceleration in lease breakage, we should see any such evolution really play out over time, not over the next 18 months, despite the bravado of some CEOs saying, well, we're truly evaluating our need for office space since we've shown we can all work from home. That's not to say that CEOs aren't carefully considering this. We've spoken to at least 20 large firms who have said as much. But as we reopen the economy, I think folks are realizing that there are tremendous benefits to working side by side, face to face in an urban setting. So I suspect that the most extreme predictions, throw out all your pants. For the record, I'm not wearing pants right now. I am wearing shorts. We're going to work from home 100% of the time. That won't come true. But individual companies are struggling with that happy medium between 0 and 100%. So my request to you all, as you see here in slide 15's title, is to assess risk in a nuanced way. I know that's literally the title of slide 7 from Hugh Kelly's presentation, but if you think I'm citing him a little too often, well, it's because I'm super excited for his news that he's about to become a grandpa. I mean, guys, there's a ton of bad news out there, so I'm going to celebrate good news when I can. This slide show good news? Kind of. Not all jobs can be done remotely. As one study from the NBER showed, about 2/3 of jobs in the DC area could be done remotely, as opposed to just slightly over half in New York City and even in LA. So think about, performers and restaurant employees and so on and so forth in New York. You can't exactly do that job online. So more to come, but from a practical point of view, the real world is messy. The average is just one number, and we need to be nuanced about individual situations and cases. So what I'll do is I'll end with specific predictions of where cap rates are going, given our historical data and economic forecasts, with all the caveats that I outlined in the 15 minutes or so. We believe that multifamily will fare better with about a 7% decline in values this year. We entered this downturn with some pretty healthy DSC and LTV levels, so the apartment sector will take some hits, but in relative terms will be fine. If you define industrial as warehouse and distribution, that sector will likely take less of a hit too, with projected declines of about 9%. Office, you're up to around 18%, and retail around 23%. If the recession ends sooner than we think, that might be it. If it cascades through 2021, given uncertainty and a bit more of a pricing hit. So I have spoken way too much, way too fast. So if you have any questions, let's reserve it for later. For now, I'll hand it over to my colleague, Chris Henkel, for his thoughts on actual industry experience. See, unlike me, the economist, Chris has the unenviable background of actually having been a banker and underwritten loans in the real world, actually presenting to credit committee. So his perspective, in my mind, really brings various points home. So Chris, Your turn. Go ahead, please. I'll move your slides for you.
Great. Thank you, Victor. So I think one of the things that over the last few months that I've spent probably most of my time dealing with is Moody's customers who are trying to wrap their head around the impact of what's going on. And we're seeing scenarios and we see information about where unemployment is, where it's headed, where GDP is, where it's headed, upside scenarios, downside scenarios. What that's doing is Victor was talking about to commercial real estate, but ultimately, how do you take what you see in terms of headlines? How do you take what you're seeing from news and excerpts of information and actually translate that in a quantitative way to a commercial real estate portfolio? So being that we're Moody's, a lot of what our customers come to us for, so banks, insurance companies, asset managers, servicers, they come to us for really looking for that historical trends and forecast perspective, but a big piece of that is to solve problems around credit risk. So I wanted to spend a little bit of time addressing that. So Victor, can you jump ahead to slide 19? And so the reason I bring this up is because especially now we're just wrapping up, a number of financial institutions wrapping up the second quarter, and you're seeing some of the areas I'll talk about in a moment. You're seeing some of the reserves being set aside for projected new problem loans and future charge-offs. You're also seeing the impact that credit risk is having on property cash flows and in turn, the downward pressure that's putting on values. So one of the things that we do is try to take a very a measured and quantitative approach to be able to estimating it. So what I'll talk about now is pretty traditional, and then I'll talk in a moment a little bit about how or why that may not necessarily apply in today's environment. So first of all, ultimately what we're looking at is, and I'll have an example that I'll walk through in just a moment, is once we understand at an individual loan level, let's look at the actual structure of how that commercial mortgage has been underwritten. So what is the amortization speed? What is the original loan to value? What was the original DSCR? And what is the interest rate? What is the spread of the interest rate for a floating rate loan? If it's a floating rate loan, and what is the projection for that index? So ultimately what we're trying to do is to quantify on a forward-looking basis what the primary drivers and financial ratios are, two of which being DSCR and LTV. So first, starting with kind of the numerator of DSCR is really looking at it from a standpoint of how can we forecast out future NOI. So one way of doing it is certainly taking different economic scenarios. So at the outset, Victor was talking about how we looked at things from like a baseline and then two downside scenarios. So in Moody's vernacular, that's our S3 and S4 economic scenarios, alternative scenarios. And when we think about this with a lot of our customers who are using that information for their allowance for credit losses in accordance with the new standard CECL, having to do so by looking at kind of probability weighted scenarios and recognizing now that even the baseline scenario already takes into account what's been happening historically, what's showing up in job numbers, what's showing up in productivity, also what's happening in real estate activity and what projections are. So the baseline is the most probable outcome. And that's information that's already kind of saying, given where we are today, as of that date, that's what we think is the most likely outcome. However, there's a 50% chance that's too high, too low. So in this environment, one of the things that we're really working with institutions and really trying to explain is, let's really look at a possible range of outcomes and let's evaluate those. And then as I talk about in a moment, really having to drill that down to more of a local level, because the headlines are important and that gives us good directional information. What that lacks though is, again, trying to bring that down to a very portfolio or even property loan specific perspective. So kind of back to that forecasting process is ultimately for a given scenario, let's say a baseline economic scenario, we look at historical performance, we look at what's happening, we look at the response of fiscal stimulus, we look at news and reports that are coming out from reporting agencies to be able to produce what those forecasts are. Then we also look at, largely with like Victor's team, for instance, to be able to understand, all right, what's actually happening in real estate markets, real estate submarkets, with transactions, with rent concessions, with vacancy rates. And where do we think, when we combine kind of that economic forecast and what we're seeing as historical activity, what does that then produce for a particular submarket and sector's forecast for rents, vacancy rates? Then we're also baking in new construction that's already started and what the inventory impact is going to be. So it allows us to really adjust and come up with that baseline outlook for the numerator of DSCR NOI. And then we also do the same on the value side, which in an environment like this is influenced largely by cap rates, but not necessarily driven exclusively by cap rates, which really is causing, probably more than anything, a big point of consternation in the conversation we're having, because of the fact that there isn't the transaction volume. So Victor alluded to earlier the widening bid-ask spread. And now if you're starting to think of this as this is directly affecting property value, which puts upward pressure on LTV, which puts upward pressure on estimates of credit risk, then that has a real financial impact. And so how do we actually get around the fact that properties aren't necessarily transacting? So even if we're seeing cap rates going from 6 to 9, 10+%, does that really mean we're going to see a 40, 50% decline or more in property values? And so we also kind of decouple a little bit just the mathematical aspect of it and really look at the incomes, because of the fact that there is that widening spread and the lack of volume. So there is a little bit of kind of subjectivity that has to be applied to it. But ultimately what that allows us to do is to come up with a future forecast of NOI and in turn DSCR and value and in turn LTV. And then from a quantitative standpoint, then map that to historical experience. So we can observe, and you can do that through credit risk models. There's data you can look at from CMBSs, there's data consortiums, there's other sources of information to ultimately come up with a way to quantify what that looks like and map that to specific credit risk measures. So I've kind of talked a little bit about the theory of it. Now what I'd like to do with slide 20 and the next couple of slides coming up after that is walk through a specific example. At the outset, I think Neil had mentioned that I'm from Texas. I'm sitting in New Jersey now, so I'll talk a little more about kind of what we're seeing here. But I lived a majority of my life in the Dallas area, so I used some of our information and some of what we saw from a customer, anonymized some of the information, to come up with an actual example of what I was just walking through. So, we have, in this example, it's an apartment complex in a submarket of Dallas called Oak Lawn. And you can see the unit mix that's on the top, so it allows us to get to the gross scheduled income of around 2.9 million. And we estimated the property income about 1.6 million and the property value of 26 million. You flip over to the right-hand side of that slide and you can see just the loan structure. So it's a $20 million loan, which is well covered by that $26 million property value. An interest rate of 5% fixed, amortizing over 30 years. So that gets us to about a 1.3 million in annual debt service, which is adequately covered by the cash flow at 1.6 million. So you can see what that starting point DSCR and starting point LTV is. And again, those feed as primary variables into the estimate of credit risk. But ultimately, and as we can all reflect on what we've seen during prior cycle shifts, it's not the levels that become problematic. It's when certain assumptions about market performance, and more specifically sub-market performance, start to change in a way that is beyond kind of expectations of what we baked in during the underwriting. So what this allows us to do is really say, all right, let's look at what's actually happening to multifamily properties in Oak Lawn under a baseline scenario, under a maybe it's not as bad scenario, or some of the downside scenarios, and come up with what do we think is the projected path of property cash flow. And then we can apply that to the actual amount of debt service to look at a new DSCR. And we can also do the same with the loan to value. So taking the information that I was describing earlier, in this example, we're looking at an NOI growth over this year and next year of around 5% decline. And then the value change of a little more than 10% over the next year and a half, and kind of seeing what that trend is. And a key thing to note here is what we're seeing is in the 3,300 or so submarkets that we cover, there is a wide range. And like, so for instance, I have a number of my old colleagues who work in the Houston area, and Houston, especially the office sector, is getting hit a little bit harder than other sectors because of their heavy reliance on the energy sector. So it's important really to be able to look at that from more of a micro and localized level. So if we are then kind of taking this structure in this example, then we can really just kind of walk through the schedule of what is the future performance. So on slide 21, what you're seeing there is a way to kind of project that out. So as I mentioned at the outset, in this example, year zero, which is our analysis date, we have a $20 million loan, and given the 5% interest rate and 30-year AM, you're looking at about a $1.3 million annual debt service. And you'll notice here that the NOI is actually quite a bit lower than the 1.6 I was mentioning a moment ago. And the reason being for that is one of the things that we're talking about in the in kind of the calculation is something that kind of points to what Victor was mentioning a moment ago with that example of the property that's for sale. Because ultimately, when we want to come up with that estimate and that forecast, really what we need to do is first, our jumping off point has to be brought current. So one of the things that we encourage is not only do you take a financial statement or an appraisal and kind of forecast out, apply forecast assumptions to that, but you also need to bring that current. So if that financial statement date is over a year old, or that appraisal is over a year old, it's important to first say, what do we think, based upon an index of comparable properties, has happened since that starting point? Because there probably has been some type of appreciation. And in some cases, depending upon the date, it could be some depreciation. And then let's use that to jump off to where we think the future path of NOI and value are. So really what you're seeing here is those assumptions that we had for this particular submarket, and applying those directly to the actual projected performance, you can kind of see what that's doing to those middle columns, the NOI and value. So then when combined with those first two columns, the loan balance and debt service columns, you can see what that does to projected DSCR and LTV. And then, as I mentioned earlier, those are two of the biggest drivers. So then we jump ahead to slide 22, and this kind of summarizes that example, which is really looking at it from a credit risk perspective. So what this is doing is we're mapping the ratios among other forms of information. So we're mapping the ratios into a model that actually looks at what are we seeing in terms of probability of default, which is that yellow line, an annual 1-year PD, and then multiplying that times a loss severity estimate, or an LGD, to get to the green line, which is the annual expected loss, and then multiplying that times the projected balance for each period going out for the next 10 years. So what you can see is in the early periods, we're looking at a likelihood of default, which is really in terms of a missed payment, missed principal or interest payment, of around 7%, peaking around 7%, and then flattening out pretty good in about years 4 or 5, and then really kind of leveling off. And so you can see what that does in terms of the dollar amount of expected loss. So that's kind of what we're seeing a lot in terms of what's actually happening now with setting aside reserves for credit losses. So what I'd like to do now is jump ahead a couple of slides. So Victor's briefly go on to slide 23. So yeah, put this in here because a lot of what I was just talking about a moment ago was really looking at it from a perspective of, okay, that what I was describing is a methodology that's not something new, and it's very relevant to today, especially when you look at applied scenarios, because again, you have to look at a range of outcomes. But we're in very unprecedented times, and how do you then account for and address the fact that some of the historic relationships between ratios don't hold, or some of the assumptions that you're seeing about unemployment and what that does may not be as relevant, especially when you start looking at more of a localized level. So one of the questions that we're getting a lot and we're researching a lot is, how do you then adjust for it? So if we advance to the next slide. So this is an interesting reference point. And so one of the things here is doing a bit of a comparison. So what you're seeing on the right-hand side is the projected path of the core 4 sectors in terms of historic and then future level of the CPPI. So you can kind of see where things are going both ordinarily, but you can also see kind of the level change and the severity of the dip. So you can see retail certainly having a much sharper decline. That's really speaking a lot of what Victor was mentioning a moment ago, followed by office, and then industrial and multifamily, which was kind of this case with the example I was mentioning a moment ago, also not having as much of a dip. So now let's actually look at what does that mean in terms of percentages, and then we'll talk about what that means in terms of actual dollars. So if you look at on the left-hand side, you see the table. What that was showing you is effectively the peak to trough by sector in terms of percentage change and how long it took to recover to get back to pre-recession levels. So you can see multifamily in the last recession had, in terms of a CPPI, Moody's Commercial Property Price Index, had a pretty significant drop of around 30%, which is considerably more than what we're projecting in the current environment under the baseline scenario of around 12%, as you can see in the table below. And everything in the table below, by the way, is projected. And then you can also look at kind of how it compares to office, retail, industrial. So the things to notice, you're seeing roughly a 30-ish% decline in the peak to trough CPPI. And you're also seeing so you're looking at the severity, the level, but you're also looking at the timing of how long the recovery took. Now we can compare that to the current projections, which are updated on a monthly basis, to where we are today. And that's kind of what you're seeing. With the exception of retail, we're currently estimating that the impact is not expected to be as severe, but there are going to be certain sectors like retail that are going to be hit harder and where recovery is going to take considerably longer. You're seeing retail, for instance, not projecting to return to 2019 levels until early 2026. So what does that mean in terms of dollars? So let's jump ahead to slide 25. And what you're seeing on these lines, so the green line reflects multifamily for the CPPI, and the yellow is for all commercial, so that's retail, industrial, and office. And again, we're talking about that 30% decline that really happened pretty sharply in 2007 through 2008, and then what that ultimately led to in terms of bank charge-offs. So that sharp decline was then followed by about $47 billion in net charge-offs. And as we're all aware, within commercial real estate, unlike other asset classes like C&I, you typically end up seeing a very flat level of charge-offs and charge-off rate for extended periods of time, peppered in by large spikes of losses. So really, this is kind of giving us an idea of, if we wanted to be able to make some inferences, we can look to the past. So what I'd like to do in the interest of time is let's jump ahead to slide 27. And I'm going to just briefly talk a little bit about some things that are making news now. So what this graph is showing you is the green bars reflect what's actually showing up on the income statement of banks, which is the provision for loan losses. So it's a direct expense on the income statement that flows through to capital, and it sets up the contra asset, the allowance for credit losses on the balance sheet. So you can see the very large spike that happened during the first quarter. And then in terms of a percentage of net operating income, so the actual income that's being generated was more than a quarter. So we're seeing that already during the first quarter alone, about a fourth of the operating revenue that was generated within the banking industry was wiped out by setting aside reserves for future credit losses. And while the second quarter numbers haven't necessarily come out across the industry, we have seen a number of larger financial institutions who've reported, and we've already seen that the level of reserves to loans has already increased by about 35% during the second quarter compared to what it was for those institutions during the first quarter. So this is basically an early indicator of what we're likely to see in terms of future charge-offs. So you can kind of couple that with where things are within certain submarkets projected to go in terms of changes in property value, changes in levels of LTV and DSCR, and use as a reference point to at least get some kind of guidance and direction on where things are headed. So one thing I also want to make sure that we talk about is, all right, again, if you don't have this is a different environment, what else do you look at? And so let's jump ahead, and I want to kind of talk about some things that have been really big conversation topics that we've been having. So what are other metrics to consider? So when people are saying, all right, I've got models, these models are producing numbers, but I can't just run solely on the outputs of numbers. What are other things that we need to be looking at? So being very obvious, the first one is progress towards a vaccine. That is certainly the most important. And we're starting to see, I think there's already 20 vaccines that are in human testing. And I think there is some news this morning that some of the larger pharmaceuticals have actually engaged in contracts with government to where they could have some emergency vaccine as early as this fall. So I think monitoring that is significant, because everything that we're saying, everything that you hear from an economist is largely based upon that. It's also based upon the new round of infections, which I'll talk about in a moment. But the other piece too is a big component is the fiscal response and the actual federal rescue funds. There was originally around $3 trillion that were approved, and so far about $2 trillion of that has already been dispersed. And then so there's discussion that's ongoing about how that's going to continue and where that's going to continue. So I think that's another big component that, one, does get baked into scenarios, but two, is something to see actually the details of where those funds go, how those end up getting allocated. And we've already talked about some of the other components with like structural changes and whatnot, so I'm not going to spend a lot of time on that. One little interesting aside is, as I mentioned earlier, I am currently living in New Jersey, so this is something that's been interesting to observe, kind of the front line, so to speak. So if we jump to slide 30. So these are just some excerpts that I took from a number of different sources, but first thing I'll mention is being in New Jersey, living in the suburbs, I've enjoyed not having to commute to the city on a daily basis. So that saved me 3 hours a day. But one of the other things that that is really been interesting is not only from news and headlines you can see here, but a number of my colleagues, a very large number of our colleagues, especially those who have young families, have already signed long-term leases to be somewhere outside of New York. And we actually put our house on the market because my daughter just graduated high school, and in 4 days we had 30 showings. So the reason I share that is because of the fact that if you want to see like what's happening, again, looking more of a micro level. So areas like New York and Los Angeles and other densely populated areas, we're definitely seeing, because of what's happening in this environment, because we're all able to sit here on Zoom and for the most part do our jobs very effectively, it does create a little bit of a shift in what the demand might be for even the least risky asset class, like sector like multifamily in some of the larger areas. So I think it's, again, the reason that I share this is it's important to be able to look at the nuanced way of things in the same way they talked about the energy sector in Houston, really taking things and understanding what's actually driving some of those fundamentals. And the last thing I'll point out in the next couple of slides is I think it all comes back to, as very obvious, it all comes back to the virus. So progress towards a vaccine is huge, herd immunity, which is going to take a lot longer. And then the other one is, which we're seeing on headlines on a daily basis, is the actual rate of positive tests and what that's doing. So if we jump to slide 31, so what you're seeing here is this is information that's being produced on a regular basis by Johns Hopkins and other sources. What this is showing you, if you look at the very bottom of the chart, you're seeing the number of new positive cases per day. So those numbers look small, but it's important to look over the last few weeks, what's actually happened to those darker orange bars. And you're seeing that uptick. Now it's actually come down this week, but you're seeing the number of positive cases per day starting to come up. And the seven-day moving average is up around 8.5%. So that's one thing to look at. But again, I'll go back to the same thing I mentioned a moment ago. It's important to go beyond local, national level headlines and actually see what's happening. So the next 4 slides, which are the only slides that I have left, are basically exactly what you're seeing now, but for the 4 largest states who can contribute to U.S. GDP. So that's in order, it's California, Texas, New York, and Florida. So those contribute the most. So if we go up to California, what you can see is this is basically, you can see that while the national unemployment rate might be around 11%, in California it's much higher at 15%. And like the U.S. as a whole, because they're a big portion of it, they're representing, they've had an uptick at about 7% of new positive tests. And so you can see that. But another one looking at is down on the bottom is the confirmed cases per 100,000. So they're, in terms of ranking, the higher the rank in this case is bad. So they're about middle of the road as far as the confirmed cases and also the deaths per 100,000 people. And it's a nice way to look at that because you can scale it from one state and one region to the next. So looking at those numbers, I think, really is important because then you look at when those positive tests come up, when those confirmed cases per 100,000 come up and those deaths per 100,000 come up, that's when governments act. That's when new stay-at-home orders, new lockdown, new business closures start to take effect. So really, if you want to say what is going to be the impact on retail in a certain submarket, one of the things important to look at is what's actually happening within those areas. So then we can also look at Texas, again, where I'm from, where they open things pretty aggressively. You can see on the next slide what that shows in terms of an uptick. So while the unemployment rate is lower than the national average and considerably lower than what you had in California, that may be a lagging indicator if we're starting to see that number of positive tests come up. So that one's up over 15% in the 7-day moving average. So looking at what that does, I've already talked to a number of people who are there and kind of the impact that's having on what the impact that's having on, you know, on basically level of businesses and closures. So let's go ahead to New York. And this is really interesting because, again, this is representing about the same percentage of GDP in terms of the rest of the U.S. But one thing that's really interesting here is you can see the percentage of positive tests have come down. And I think that's largely in response to what you're seeing on the last two bullets there, where the confirmed cases per 100,000 and deaths per 100,000 have been essentially leading the rest of the U.S. The New Jersey, unfortunately, is the one who's leading in terms of the death per 100,000. But that number of positive tests is pretty much flattened out. And so that's where you're starting to see some more openings, more things that are actually happening in New York, in New Jersey, in Connecticut, where they're trying to respond and rebound a little bit. And the last one I'll talk about, and then we'll turn it over to Neil for questions, is in Florida. So not only do you see that second bullet point that more than 1 in every 5 people in Florida are over 65, so that's huge in terms of the risk profile, but you're also seeing the number of positive tests are also nearing 20%. So that's pretty significant. And that's going to obviously have an upward effect on what we're seeing in terms of the confirmed cases and deaths. So the reason I bring these pieces of information up, and it's not necessarily related directly to commercial real estate, but ultimately the response that markets are going to have, the response that local governments are going to have, are going to be directly influenced by the numbers that these are coming out. So I bring this up as a point in the same way with a lot of the institutions and customers that I'm speaking with, is that's really going to be a nice leading indicator to be able to see what's projected to happen. If you're looking for ways to adjust outputs, that's kind of another metric to really look at to rewrite that narrative. So with that, I'm going to pause and I'm going to turn it back over to talk about some of the questions.
Thanks, Chris. We do have a number of questions from the audience, and here are a few of them. One is, we seem to be seeing quite a range of economic forecasts in our, from various economists we hear. Some will forecast a deep depression. Others are forecasting a quick return to the economy. And what needs to happen before that becomes more clear?
I guess I can start, and then Victor, I'll let you kind of talk about it because you're an economist. I think ultimately what becomes more clear, going back to what I was just mentioning a moment ago, I think there's tremendous uncertainty around where things are headed, how fast to open things up. And we're getting daily information. And that daily information and the response from local governments, from federal governments, from stimulus, that's really driving a lot of what's happening in some of those economic forecasts. So that's, I think, the more you look at that and kind of bake that into some of your assumptions, then I think that kind of influences the the probability of the different paths within economic scenarios. Now, Victor, what's your take? I think you're on mute or you're speaking very quietly.
I see.
Yeah.
Thank you. It might have also been the bad dubbing into English, but I do think this is classic. This is a classic economist sitting on a fence, right? But there is a basis for it. At the end of the day, because of the uncertainty around this virus and how it's progressing and how it's going to be handled, what ends up happening is you're going to have a range of scenarios, right? And at the end of the day, there's a baseline expected scenario. You can assign probabilities to it, but the range of the upside and downside is actually quite large. And I do say this in some presentations as an economist. I have never experienced a situation in my career trying to read the tea leaves where I'm hoping that a year from now we'll be having a conversation and I will be wrong on a bunch of my downside scenarios, right? So in other words, summer months happened, the vaccine came in, Pfizer just came in with 100 million units worth of stuff that actually worked. And a year from now, we're all wondering, wow, what was that crazy 4 or 5 month period when we all sheltered in? If that doesn't happen, though, I think we just have to be prepared for that downside. So yeah, you're absolutely right. There are a range of scenarios out there trying to account for the uncertainty that we're experiencing right now, Neil.
And yeah, the headline said 100 million vaccines from Pfizer this morning. That's not enough for everybody in America. But moreover, it's not enough for everybody in the world. So, suppose we can produce enough vaccines for everybody in America. Are we going to, what do we do about the rest of the world? Do we, and where are those vaccines going? Are they just for Americans or for the rest of the world? And how does that work?
Yep. So it's all that uncertainty about living in a more globalized world with open economies who do need each other, with open borders for trade and commerce, right? That just increases the uncertainty quite a lot. And to your point, Neil, we're just assuming those vaccines are actually effective, right? It has to be credible, reliable, and made widely available. Those are the three conditions. Credible so that Neil will take it, because I don't know how it's going to affect you in 6 to 9 months. It might compromise your autoimmune system. I don't know. You're reliable because, yeah, if you take it and it's only 50, 60% effective, then I'm not sure. Is it a situation like seasonal flu then, where we're just going to have, inoculations every 6 months or so? And finally, to your point, Neil, it has to be made widely available. Otherwise, well, what's the point? And someone else is just going to infect you once they come into your borders.
Right. And in terms of the response, how do you see capital responding? I kind of imagine two extremes. One is real estate opportunity fund managers I've spoken to who are already singing the grave dancer song, saying, this is going to be a great buying opportunity. We're going to buy low, we'll sell high later. And yet when I speak to people in the institutional world, there's more of a tendency to extend and pretend. Let's not rock the boat. Let's not write assets down too far. Let's not sell things at the bottom of the market. How do you think the capital settles out between those two?
Chris, you want to comment on that, or I can comment on it too?
Yeah, sure. Go ahead.
Yeah, I think the proof in the pudding here is whether or not we'll see transactions happening, right? That's when you'll see any kind of evidence that capital is settling in some form. What was it? The headline today too was it KKR that has close to a few $100 million for opportunities in distressed funds. So at least they were specific. They weren't buying properties. They're looking at probably distressed CMBS, because that's really what's coming to light right now. But as far as our data shows, 47% decline in transaction volume first half of 2020 versus first half of 2019. If you look at it quarter over quarter, it was 42% down in the first quarter, 46% down in the second quarter. We're having a webinar with Jamie Woodwell later today from the Mortgage Bankers Association. He's going to tell you guys that originations are down 59%, right? So I suspect, to murder what Rudyard Kipling wrote in 1889 about the East and West, the twain has yet to meet, right? And I think the longer this crisis goes, the longer the duration of this crisis, the more pressure there will be on the guys who are waiting and seeing to go and say, okay, if we have to offload assets now, what kind of a haircut will it be? And I'm not sure there's an answer to that, because on top of this, it's not just an asset bubble that will return pretty soon, right? It's not just a pricing-driven recession. We're having serious discussions about the future use of the built environment. And that will fundamentally affect your investment thesis, because even if you get a mall at a 40% discount, is that a good deal? Is Brooks Brothers coming back? I don't know. So we'll see. Brooks Brothers might be coming back, but only for shirts and not for pants. I don't know. So, Chris, maybe a comment on your end.
Yeah, I think I agree with what you're saying. I think the big thing is when people are looking at this from a financial standpoint. So I get a lot of the conversation I've had has been around trying to determine what is potential credit losses. And people are saying, when you look at 20, 30, 40% projected decline in property values, people are saying, well, those are on paper, they're not real, because we're going to be writing this out. So I think it's really understanding, like, there's the kind of the quantitative view of it, but then how are things actually for those who are actually holding it? So for lenders or for investors who are holding on to those assets, they're looking at this in terms of, well, we know that in time, we don't know what the timing is, but things are going to recover, things are going to get better. And it doesn't make a lot of sense for me to have to set aside a considerable amount for losses that I don't think necessarily will happen. Now, there's a lot of uncertainty around that. There's obviously an auditor view of that, but I think that's really important. But to your point earlier, Victor, the longer this drags out, the more uncertainty there is. And if that gap stays wide, I think it's not going to be to the advantage of people who are holding those assets.
Sounds to me like it's liquidity driven. In other words, if they don't have to sell, if institutions don't have to sell, they won't sell. But if there's a liquidity event where they have to actually start looking at their illiquid assets as a source of liquidity, then that's sort of where the rubber meets the road, isn't it?
Yeah, definitely see that. And that's kind of like larger institutions, smaller institution too. You're even seeing like just cash on hand, same with like local businesses.
Yep. Another question on the thesis that half of city dwellers would move if they could work remotely. What was the polling methodology behind that?
Well, that's a study from Redfin. I don't recall offhand all of the exact details, but I know that when they did a study that they, like I said, that what they're, and for those who maybe don't recall, because I didn't go into that more specifically, is the Redfin, the residential real estate brokerage, they did a survey of people living in densely populated metropolitan areas, and they said if working remote became permanent, people that are in those areas like New York, Boston, San Francisco, Seattle would prefer, half those people would prefer to work somewhere else. And so as far as the actual methodology of that, I'm not exactly sure specifically what questions were being asked. Anecdotally, I can say that a number of my colleagues who do live in New York have temporarily relocated to areas outside of the New York metropolitan area. And they've all said that if this continues and we're allowed to keep working from home, I may not go back. So I'm at least not going to go back for 6 months or a year, but I may not go back at all. I may just, this is an opportunity to get out of the city.
Interesting. question on cap rates. Do you have cap rates for hotels? You mentioned the other property types. Do you have any hotel data?
Yeah, we do, and probably I probably didn't present it on purpose because I didn't want to go too negative, right? So our projections for hotel are going to be even worse. Surprise! I believe that we moved, just to give you a sense of how our outlook changed, right? In Q1, our outlook for RevPAR declines was something like 23%, and now our outlook is down 47 to 48% for the entire year. Think about that in terms of how you want to project out asset values and what that will mean for cap rates. But I mean, I think the good thing is, quote unquote, right? Unlike retail, which is, I think, experiencing a big structural shift, the hope is that if and when travel returns, if it returns in some form, that hotels and lodging will actually bounce back. Now, that's not what our economics group thinks, right, Chris? When we took a look at our leisure and hospitality employment forecasts, it doesn't return at all to end 2019 levels for the 10-year period. I'm going to have to ask Mark Zandi, hey, do you forecast out 30 years, and do you think it'll ever return? So that gives you a sense of, quote unquote, again, economists differing on where things will go, but hotels are really on the ropes right now, at least in the short run.
Final question as we wrap things up. Let's pretend for a minute that there is a vaccine in place in the first quarter of 2021. What does the rest of 2021 look like?
I'll speculate on that. Again, it will depend on the two things: the distribution and efficacy of the vaccine, right? Again, if this is truly a silver bullet, then, I don't think we will revert back to end 2019 habits because it's extended for so long. But I suspect that the bounce back will be pretty significant. Now, what's arguing against that wildly optimistic point of view is that, number one, there has never been a vaccine for the coronavirus family ever invented, right, in history. Number two, I'm not sure we fully understand how this virus works. I think it's only fairly recently that we understood that chickenpox incurred at youth actually might give you shingles if it resurfaces in old age. So, I'm hoping for the best. How about that? And if it's somewhere in between the worst that could happen, where we're forecasting 100% office vacancies, we're not, right? Then I'll take the happy medium. But if there's a silver bullet that comes and I can send my critters out, these kids that are bothering me right now, to school once again, I'm all for it. So I'm hoping that my downside forecasts, the worst of it, are wrong.
Great. Well, thank you, Chris and Victor. This has been fantastic. And thanks to our attendees for participating. Thanks for all the questions. Thanks for sharing this with us. We truly appreciate your involvement and hope to welcome you back sometime soon for another in this series. Thanks again, everyone.